Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, January 16th. The markets lit up with joy yesterday on the back of softer than expected inflation numbers from the UK and the US, as well as strong bank earnings in the fourth quarter. Yields fell and equities gained. But note that the sky isn't entirely clear just yet. There are still reasons for concern. So yes, ladies and gentlemen, yesterday offered an almost ideal news flow for global investors. First, the British inflation came in softer than expected by analysts, with the Moss Watch Services inflation metric easing from 5 to 4.4% in December, the lowest since March 2022, and leading to a much-needed relief in the UK's gilt markets. So the 10-year gilt yield gapped lower at the start of the trading session yesterday in London and is about 20 basis points yesterday compared to the day before. Cable rebounded on this bond relief, and the FTSE 100 stocks rallied more than 1% on the expectation that the Bank of England could cut its interest rates twice this year. Then, in the afternoon, the US took over and announced a set of softer than expected inflation figures as well. The headline inflation in the US rebounded from 2.7 to 2.9% as expected in December, but core inflation eased unexpectedly from 3.3 to 3.2%. And the cherry on top, the Empire State Manufacturing Index unexpectedly plunged in January as well, offering some relief to the Federal Reserve, those which have been actually spending the first weeks of this new year watching their dream of interest rate cuts from the Fed sailing away. So, yesterday's data brought some of these expectations back on the table. The US 2-year yield, which captures the Federal Reserve rate expectations, plunged more than 10 basis points yesterday to below 4.30% level, and the US 10-year yield dived up to 15 basis points to 4.65%. Now, activity on Fed funds futures hints that the Fed's next rate cut could arrive in May and not in June, and that's obviously a blast for the equity markets, which also benefited from a set of strong looking earnings from the big US banks yesterday. They actually opened the earnings dance at yesterday's trading session. So together, the four big banks that released earnings yesterday, namely JP Morgan, Wells Fargo, Goldman Sachs, and Citigroup, so together these four banks printed more than 100 billion US dollars profit last year. That's the second highest yearly profit ever. And individually, JP Morgan alone topped a 50 billion US dollar annual profit thanks to exceptional jump in profits boosted by election volatility in the fourth quarter. Wells Fargo announced a 12% cut in its expenses. Goldman Sachs' fourth quarter profit doubled compared to a year ago, while Citigroup stayed a bit behind but gained investors' heart yesterday with a 20 billion US dollar worth of a stock buyback announcement. So all in all, Invesco's bank ETF jumped more than 4% yesterday, and more big banks from the US will be releasing their earnings today. Now, zooming out, the S&P 500 gained more than 1.80% yesterday on the back of softer than expected inflation data from the US and these better than expected bank earnings. The Magnificent Seven rallied more than 3.5% yesterday, despite discouraging news of more export curbs for chip companies toward China, and the rally will certainly be boosted again today by better than expected TSM earnings that just came in this morning, and that already led to a 4% jump in TSM shares in Taiwan after the earnings, as the company's revenue rose nearly 39% in the fourth quarter compared to a year earlier, and their net profit jumped 57% on strong AI demand. Oui, the story continues. In Europe, the STOXX 600 index traded past its 200-day moving average. Crude oil rallied above the $80 per barrel psychological resistance despite the ceasefire agreement in Gaza, and the US dollar gave back gains at yesterday's trading session on soft CPI data, but the gains are being recovered this morning before the December retail sales data from the US, which could eventually show that the strength in US consumer spending continues, and that could counter a part of yesterday's optimism on inflation. Because zooming out, note that the core inflation in the US is still above the 3% mark, which is still well above the Fed's 2% target and is hardly coming lower. And the trade war between the US and China is now about to spread toward the rest of the world, with Donald Trump officially moving toward the White House next week. So even though his new team is now aiming to raise the tariffs gradually, a 10% universal tariff and a 60% tariff for China would amount in an average tariff of 17%, according to Barclays analysts, and could only raise the pressure on consumer prices in the US and perhaps elsewhere as well. Plus, this went mostly unseen yesterday, but the German economy shrank for the second consecutive year in 2024 for the very first time since the beginning of 2000s. And given the actual state of things in Germany, and I'm talking about the troubles that we see in the German industries, and especially in the German car industry, and also the political uncertainties with the upcoming snap elections, well, Germany is not expected to do much better this year. So the latter weakness in German and the European economies is maintaining that hope that the European Central Bank will give an ample support to the weak and the weakening European economies this year, and that weakness or the dovishness for the ECB helps explaining why the DAX index hit a fresh record high yesterday despite the bad news. But the Eurodollar is having a hard time maintaining its advance above the 1.03 mark, mind you. If a broadly softer US dollar on soft inflation data from the US couldn't help to reverse losses in the Eurodollar, it means to me that the bearish tide is relatively strong right now. The euro pound, however, hit a high mark of its downtrending channel at 0.8463 level yesterday, as sterling on its end remains under a bigger selling pressure due to the British debt headaches of these days, while bulls and bears, sterling bulls and bears, are still struggling to take the lead around the 1.22 level against the US dollar this morning. The expectations that the Bank of England could eventually cut its interest rates twice this year actually gives some relief to the UK's gilt market. Hence decreases the chances of more concessions from Rachel Reeves on her spending plans, and that improves the UK's growth outlook. But note that is a mega improvement for sentiment, mind you, because this morning's GDP update from the UK, well, it came in lower than expected by analysts for November, keeping the outlook for sterling firmly in the bearish camp. Elsewhere, the dollar yen took a big dive yesterday and tipped a toe below the 156 level on the combination of a broadly softer US dollar on soft inflation data and a strong rebound in the Japanese yen on rising expectation that the Bank of Japan could announce a rate hike as early as next week. So if that's the case, if the Bank of Japan goes ahead and hikes its interest rates next week, we could then see the dollar yen return below its 200-day moving average, which is near 152.80 level, and even test the major 38.2% Fibonacci support on September to January rebound to the downside. That's near 151.15 level, and a slide below this level would indicate a medium-term bearish reversal for the dollar yen. In the energy space, the fact that the crude oil is now trading near the $80 per barrel level raises a few questions. The latest rally in crude oil prices was led by the geopolitical factors and brought the IEA to revise its surplus forecast for this year lower, so that's positive. Then the prospects of rate cuts from the major central banks around the world are also supportive of the demand outlook, hence prices. But for now, the gains have been mostly supported by the supply side news than the demand side news, hence remain vulnerable to a correction. I expect to see increased incentive to sell the top near the $80 per barrel level and a support near the $75 to $77 per barrel range. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.